G'day listeners and welcome to another episode of the Scouting Australia podcast, powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, we have back in the studio, he's got a different hat on, his shirt still looks like he's got something funky on it, Mr. Big Jimmy Ibrahim. Mate, welcome back to the show.
G'day, Sammy, and g'day, listeners. Good to be back here, mate. How you been?
It is good to have you back. I'm well, thank you, mate.
Good.
I'm quite well.
Very good.
Mate,
very good.
Sunny old Queensland. Things are nice up here at the moment. It's a beautiful place to live.
It is. It is. Well, hello to all of our Southerners listening, all of our fellow Melburnians, or anywhere around Australia, because we've got something for everybody. And today, Sammy, is the amount of people that are talking about interest rates. Have you heard people talk about interest rates?
A lot. For a long time now. Feels like fucking forever.
So let's just go over it again, just in case you've missed the memo.
What the reason for this episode today, guys, and what we really want to unpack is about a month ago or maybe 2 months ago, something like that. We did an app on should you buy now or wait.
Yes.
And the reason we did that app is because heaps of people were asking us that all the time. It was getting sent in constantly on the socials, on the front end, on the disco calls with Lukey and I on the strategies on the back end. People still feeling a bit uncertain and asking constantly, should I buy now? Listening back to it as well. But another question we kind of got off the back of it as well was like, yeah, we understand everything, but then some people still kind of, I think, looking for a bit of reinforcement around like the high interest rate environment that we're currently in. I think it's a beautiful time at the moment in a way because like we went on such a rapid run for so long. Now we've had a hold period of rates for a few months, 3-4 months now as well, which has been awesome. It's really setting the tone that we are pretty much very close to the peak in terms of the interest rate cycle at the moment as well. Obviously, inflation doing what it's doing and seeing where that lands. The RBA is being very careful at the moment in terms of how much further they pull the trigger with it as well. But yeah, man, it's the big question we get asked all the time. Well, if you can't guarantee positive cash flow in this market, if the interest rate are this high, what else is going to happen in the market? So look, mate, I really just wanted to unpack, really in a nutshell, should you invest in a high interest rate environment, and kind of go down that avenue as well. It's a bit of an extension from the app we did 1-2 months ago, whenever it was.
Yep.
And then, yeah, man, really dive into that. And mate, I want to do a short and snappy one. We've got the steaks on the barbie. We've got the Wagyus on the slow burn. So I reckon we've got 30 minutes, mate, to punch this thing out. Let's do this short and snappy and get to the point.
I think we should, Sammy. And for all the listeners, get your pads and your pencils out because there's going to be some gold here. And, on a very high level, Sammy, you're very bullish when it comes to investing. And I love that about you.
Thank you, mate.
And there's always going to be an environment to invest your capital.
Yes.
Right? So interest rates are one of those things that you've got almost a couple of different camps, don't you? You got the people that are getting really fearful and they're looking very narrow, and you got people who have a bit more of a broader picture and understanding what's happening economically. So I thought a great place to start, if you don't mind, is really around breaking it down for people, how higher interest rates do impact property in general. So things like your serviceability and so why does a higher interest rate environment, just making it very simple.
Yeah. The biggest thing is it affects the cost of living. It's the whole point of doing is it affects the cost of living, of household expenditure, and surplus income, right? So when interest rates are super, super low and you're making $1,000 a week, but your repayments are $300 a week, you got a $700 surplus.
Yep.
But when they go up to 7% and they go to $700 a week or 6% $600 a week, you're eating up so much of that additional or surplus income that you have. So the cost of living increases dramatically when they go on the sort of run that we've just had now as well. And that obviously, when you're affecting the cost of living, you're affecting how people feel out there in the marketplace. And that is the whole reason the RBA does it. It is their blunt instrument that they have. They only have one tool that they can use to really put to effect here and affect the market in the way that they need to do. And so when inflation is going on that run away like it was, what they needed to do essentially, especially in their mind as well, was jack up rates to that point where people don't feel overly wealthy, where they are feeling the pinch and they are struggling a little bit more from that sense, and essentially to curb the spending. Curbing spending, in turn curbing inflation as much as they can.
So trying to cool the economic environment to stop people spending. And then when it gets to a point for people out there listening thinking, okay, so when are they going to pull it back? Is it a point which the economy has slowed enough that they actually need to drop interest rates to then get people to spend more money to almost boot the economy, like what happened in COVID, right?
Yeah, 100%, man. And that's why I say it's their blunt lever. It's the only instrument they've really got at their disposal, is affecting people's surplus cash. Yeah. So when times are tough, and the economy's struggling, hence COVID, GFC times, or all these different sort of times like that where people were struggling, man, dropping the interest rates, especially you look at COVID, people weren't spending money. People were very scared. Dropping interest rates and making that cost of living and that affordability a lot higher, man, it made people go out there and spend a lot more money. And it was smart what they did. It had the great effect, in terms of getting people out there and spending more money. Yeah, discretionary spending increasing. Yep. Majority of people are going to go out there and spend more money.
So, and we might be covering some of the topics and in the conversation for people thinking, well, this is pretty simple. But everyone's at a different point, folks. So we're trying to create an environment that makes it really simple.
But this is the basics, right?
Yeah.
This is obviously we're getting into a different topic, being like, should you invest in this environment? Yes. And this is where a lot of people are sitting on the fence at the moment because they don't feel like, or they're worried about the rates, or maybe they bought one property 2-3 years ago and they bought it with a 2.5% interest rate, and now they're going, oh well, I'm not going to go buy now because interest rates are 6.5%, 7%. I'm not going to go buy when it costs me that much now. And I think it's unpacking and dissecting whether that is worthwhile doing, and how to look at it as well.
So in saying that, then household income is reduced. Now, how does that higher interest rate environment affect household pricing?
Sorry, say that again.
How does
so
the higher interest rate environment affect house prices? I know that there's a few impacts.
Right.
But for people listening thinking, okay, so I get it, we've got less money.
Yep.
But how does that affect pricing of property?
The way that I always see it is your more affordable areas, or say the areas that haven't seen significant booms in recent times, or your more affordable areas that maybe just haven't been on a run for a bit. Even ones that have been on a run typically aren't as affected, right? It always comes down to affordability of an area. So when an area has had a significant run for a long period of time, or it's just come off the back of a significant run, jacked up interest rates are going to massively hurt that location. The reason for it is because people go in there buying into that area with the idea of, well, this is what my interest rate is at. This is what it's going to cost me. Now it's gone to this. I can't really afford this anymore, or I have to rein in my spending to still afford this. And that is what the idea of what the RBA does it for. They're like, okay, most people will do everything they can to hang on to that property, but it means they're not going to go out and put all the rest of their cash into the economy.
Yes.
So what we find is those areas that have had a significant amount of growth, or are just very expensive for what they are, a lot of the time it's like your higher demand sort of areas as well. People are buying in there that are like reaching really their limits. They're really stretching for what they're going for a lot of the time in there too. They get affected more by it than your lower, essentially like your blue collar style areas. It doesn't necessarily ignite a market, it can definitely curb and pull back markets that are
slow the market.
That are higher up. But it's not like it's the exact opposite for the lower markets as well. Yeah, man. But what it essentially can do is bring more properties to the market for people who can need to pull out. But that's normally what it is from that top end of the market. That's how it can curb it from that end. It doesn't really affect price growth, essentially, like putting it on that way. It's more affecting the areas that have kind of topped out from an afford. It always comes down to affordability. So like when a market reaches its peak, it's almost always due to affordability.
Yeah.
Providing all the other fundamentals are correct. Normally what tops a market out is affordability. What's the first thing to affect affordability is the cost of housing in that area essentially going through the roof. So that's either through, and let me just repeat that for one sec, the cost of the housing. So it doesn't necessarily mean the purchase price, but it can mean the repayments or the rent or what it costs to actually live in that place. So the cost of housing, not the actual purchase price of it. So let's say a market that's how it brings them back, because you already reached a market peak. Then you've thrown the additional cost of living on top of it, like substantially increased it. And that's what causes essentially the pullback in those markets.
Okay.
The interesting thing that we've witnessed in the last especially the last 12 months. Last year, 2022 was a pretty brutal year for a lot of those markets that had a great run during COVID. A lot of those really sharp interest rate increases affect a lot of those markets. Those markets like had a pretty significant dip in the back end of 22. But the super tight stock levels that are still around the country definitely put a floor under it, so it didn't fall back too much. We are seeing a little bit of a change, a little bit of shift in that at the moment. Spring selling season came in this month, and it's been very interesting to watch the increase in listings in both Sydney and Melbourne over the past 60 days. Actually, I saw the data come out at the start of this month for what had come in the back end of winter. Very interesting to see. Yeah, essentially that.
Do you think that's
come in?
Do you think that's because people are finally getting affected, or the filtering through of that pain, or is it because this is the best time theoretically in spring to sell, and there's more buyers in the market around approaching summer?
Yeah, it's a bit of a mix, man. I think a lot of people are starting to feel the pinch. Obviously, of those more expensive markets, so more people are feeling the pinch and going, yeah, interest rates have now actually set in at the top. Because people think like, oh, we've been running for ages. How have people not been feeling it yet? Because we haven't been at the top. But now we are at pretty much, or realistically pretty close to the top, if not at the top. And we've been here now for call it pretty well 6 months. We've been pretty close to the level that we are now. So it's starting to set in. The realism of it is starting to set in, and a lot of people can't afford it. So a lot of people are cashing out, and at the same time, a lot of people are actually moving out of those cities as well. You're seeing a lot of interstate net migration is quite strong in the other states compared to those two as well. So yeah, man, I think we're seeing a few different factors kind of really pressing in on those states in particular.
So in saying that, right, you're talking about different markets that have had that impact with interest rates, and they have pulled back. But there have been markets that have still been incredibly bullish over the last couple of years as interest rates have continued to go up. So I'm curious, for the listeners out there, what are the other main drivers that people really should be looking at that are driving pricing and affecting pricing that makes it a no-brainer? Like, we're talking about, should you invest in a high interest rate environment?
Yeah.
If there are markets that are increasing, it just shows you you should be doing it. So what are the other drivers?
So I think like the biggest thing that we're looking at the moment, the strongest thing that's been in place since the wind-up of COVID and essentially, which was late 21, early 22, but then in the 12 months after that, Australia really reopening its borders. The biggest thing that we've been witnessing is the population growth. And then obviously it was 3-4 months ago now as well. A lot of things coming out, with Australia seriously ramping up their immigration policies to get as many people into the country as possible. Skilled migrants, essentially. Man, that is putting a lot of demand on affordable areas. So a lot of people, they come into the country and it's putting a lot of demand across the whole country. Don't let that, I guess miss you on that front or think I'm not saying that. It's putting a lot of demand on the whole country, but where is really feeling it is the areas that are affordable. This is one of the other reasons it's kind of helping hold a lot of the more expensive markets as well. If that wasn't there, they may be bottoming out, coming a little bit further away now as well. But when you throw that on top of markets that are already seeing some quite strong growth, both from an affordability perspective, so a lot of these other states you're talking about, or these other cities that you're talking about, they're having great runs, and they've been on great runs for potentially 1-2 years now. Interest rates seemingly haven't affected those markets. And your biggest things are your infrastructure going into those areas, your strong population growth, supply to demand ratio absolutely falling through the floor with listings and with stock actually available. And then the biggest one, which I've probably been harping on for a little bit now, is the affordability factor. So when you have all those things there on top, and then that population is really driving really, really hard. I think we obviously it was a few weeks ago now, might have been about a month ago now, that we did the round table discussion with the guys as well. We spoke about this a little bit there on the immigration piece as well, that we did a little bit of a potty on as well. All that sort of stuff, man, is like so relevant for what's driving these more affordable locations at the moment, because they're really feeling the pinch of all this additional pressure on the market with so much fewer listings. That's what's still driving the market right now. We're going to get into this in a little bit later in this app, but when you think about it, if that's what the market's doing now and it's still pumping, and like
in a high interest rate environment,
what's going to happen in the next 12, 18, 24 months? When the economy's stalling, they've finally got inflation under control,
Boxing Day sales when they open the doors.
Flooded in.
They jumping over
I
each
thought I
other.
saw you on the TV one year doing that, going straight for the ladies' handbags. Add a few to the collection.
Yeah, no, of course. But that's what it's going to be like, right?
It will be.
So you don't
I
want
think
to be...
Morg's brought that point up, you know, in the round
100%.
table. She was talking about that. And it's a very valid point. And man, I think it's going to be a game changing sort of time. And I think this is where, you know, and the point of discussion, I know you got a bit of a skeleton, you know, a bit of a structure here that you've kind of built in that you want to talk through. But I think this is where this whole chat is really going. You know, people being scared and holding off and sitting on the fence in this environment. But there's just so much going on at the moment that they're really the only thing holding back some of those markets from doing potentially like 40% a year, 30, 40% a year. A lot of them are doing 20% plus a year. The only thing really stopping them is the interest rates where they're at the moment. And majority of investors and home buyers actually sitting on the sidelines.
Which makes, if you're listening out there and you're not actively seeking out this information and you're only limiting yourself to the market that you live in, like Sydney or Melbourne, essentially you're saying you're missing out on an incredible opportunity.
Yeah.
I mean, if we were to just break it all down, we could probably wrap up the episode in saying that if there are markets in this current high interest rate environment that have continued to outperform and are continuing to grow, that you could have potentially put your money in. I mean, you put it pretty well. If there's a no-brainer. Once interest rates pull back, they're not going to, what's going to happen? It's going to put a fuel on the fire and it's just going to explode.
Yeah, 100%. And this is the biggest thing. Like the only way, again, we've spoken about this recently on potties, to really curb this at the moment is bringing more supply to the market, which is always too slow. They can never keep up with it. That's why I love to actually exit markets at the peak, because when you go past the peak, it's normally when the supply starts to catch up with the demand and overtakes it. That's what causes the market to dip back and then flood again. Whereas if you're selling out at the peak and you're riding out of it and you're going into a different market to then witness the same things. That's why I love doing it. Because then when that market gets reflooded, the affordability tops out. You know, it's not the best time to hold after that point. You're in for a long stagnation once you hit that.
I know we've spoken about this in previous podcasts, but if those migration numbers drop or the government does stop it completely, will that help appease the market?
Definitely. So it will definitely slow things down, because at the moment, the biggest issue is there's so much pressure on the rental market right now. Like we're in a serious rental crisis right now. And I think like that is a huge part of what's out there at the moment. Driving that is the immigration of people, new migrants coming to the country, and they can't buy. Like majority of people who come, when I say majority, I'm literally talking like 999 out of 1,000 people, probably more, can't buy when they first move into a new country. They don't have serviceability. They're not residents. Sometimes you might get some people that are coming in with cash that maybe can buy something. But most people want to figure out where they want to live first. So they normally rent. The other thing of renting for the first couple of years is then you can apply for residency and actually go for loans. So normally what will happen before you can even apply for it, then it takes time to get it. And then you can maybe apply for your loan, especially if you've decided on where you want to live. But they're looking to push this hard for the next 4 years. So realistically, you got 4 years of pipeline of this just compounding on top of each other. But then also the timeline and the lag after it of people still needing to get their 2-3 years in the tank before they can start to buy. That is pure pressure on the housing market. Pure pressure from a rental perspective. And so what that's going to do is that will keep pushing, exacerbating rental growth. Hence why we've seen so much rental growth over the past, especially the past 2 years, has been exceptionally strong. But what that does is it pushes all probably the Australian residents that are now topping out from a rental affordability in their transition and jumping in. So there's continual pressure. It does 100% affect both sides of the market.
Which I know we've played around with this and joked on previous episodes, but
don't play around with anything in my company, mate.
Those people that are taking up stock, and that's what's causing rents to increase. Whereas a big myth is that investors, by buying more properties, and they're creating a rental crisis.
Yes. So
the uneducated person you can confuse yourself to understand what's happening at a real base level economics, 100%. Right? So when you're doing things like putting a granny flat or you're adding more dwellings into the market, you're essentially helping housing rental affordability. as an investor.
Yeah, 100%. Yeah, you're bringing more product to the market instead of something being a singular dwelling. You're bringing the double to the market.
Because it is easy to have a pot shot at investors. And I know,
100%.
So for people listening and thinking, I mean, a lot of our listeners, they understand the value of that. But I think it's just really important to really get your head around why it is happening.
Yeah.
So, okay. Well, that all makes sense, right? So we understand there are a lot of other drivers that are affecting housing pricing and that interest rates, although they do affect, they're not the main driver of pricing, which is another tick why you should continue to invest in this current environment and continue to do so moving forward, knowing that interest rates are quite high, they've peaked, they may be on the downturn at some point, but this is a great opportunity. You do not want to miss out on these markets that are continuing to grow.
Yeah.
Right? Because my question is, as an investor, and any investor out there is looking at the return for their capital. So if you're not investing your money in housing, and let's just say hypothetically, you know what, I'm not investing, interest rates are too high, I don't want to buy properties, what else are you doing with your money?
Yeah, 100%. What are you just going to do? Park in the bank or sit in the offset or whatever? Yeah, man. Or like if you don't have an offset and you're literally just you're renting somewhere, like the idea was to rent invest, but you're going to wait for pricing to come down. You're literally going to be competing with the masses when that tide turns. And I've actually had a lot of strategy sessions with clients around this as well. Even returning clients that have come through, they've got 2-3 properties in the tank, and they're like, "Oh, mate, maybe I think I'm just going to sit the sideline." Until interest rates come back down. And I'm like, mate, do what makes you feel comfortable. But like if you run the numbers and you guys can still afford to, and it's not going to be a big financial burden on you guys, why wouldn't you get another 1 or 2 in the tank before the market turns again? Because that is literally what we're looking at here. Like I am a very bullish person on the property market, but I'm also extremely convinced that like we're literally at we're at a point where we're kind of almost like at the most exposed point in the market right now from an interest rate perspective. And yet there are plenty of markets out there doing 20, 25, 30% growth a year at the moment. Like what are those markets going to do when you chop 1-2% off the interest rates to then reignite the economy again? What about the other ones that are like just sitting there at the bottom, just starting to bubble away, and all they need is that little match? And the other locations that are kind of maybe peaking out in 2 or 3 years, as those markets are peaking out, smart investors will be pulling their money out of those markets and looking for the next place that will be the ripe to be investing in at that time as well. You want to be getting into those markets early. You don't want to be waiting for the markets to turn and then all of a sudden it's on and you're competing with everyone and you're going to get FOMO and you're going to overpay. You want to buy when you're in a more controlled environment. You are competing with less people and the market isn't as hot. So if you can do that in a higher interest rate environment, and yes, cop something that, I mean, if you look at it, something's $400,000, $500,000, $600,000. Maybe it costs you $5,000, $3,000, $4,000, $5,000 a year at current interest rates to own, and then in a year, 2 years, your interest rates are back by 1-2%. And now it's breaking even or in front. But the growth like that you've made in that time frame, you made money on the way in the deal. You've had the growth on it as well, compounding your growth, especially if you've owned it for 2 years. But now the interest rates are coming back. Your cash flows on that thing are turning positive. You've had rental growth. Now the market's absolutely charging, but you're already looking for the next one because you pulled equity out of it, you bought another one, and now you pulled equity out of both of those and you're buying again somewhere else, and you're letting that market FOMO come in to then send the market as well. And that's how I'd be looking at it. I wouldn't be looking at, I'm going to save my money, I sit on my hands, and like different people have a different risk profile, but like, what are you waiting? You're going to wait for the interest rates to come back and the stampede to come in and Jimmy, knocking you over for a couple of pink handbags on Boxing Day sales. Like that's literally what it's like, man. Like when FOMO sets in, unless you've got a very, very good ability to buy off market, like working with Australian Property Scout, you're not going to get that opportunity.
So do you think people have gotten soft, Sammy, with cheap interest rates? They had a lot of comfort, thinking, you know what, shooting fish in a barrel. It was you could pick and do quite well. And now, do you think it's a psychological piece that people can't get their head around losing $5,000 a year? Let's just say it's negatively geared, and they're not going to be paying $5,000. But after they're losing a bit of money, and because it's not tangible to get that 50 or 60 grand in their account of growth. Is that the piece that's stopping people from making a decision?
What I think people have become, it's not so much that I think people have become soft. I think what it is new investors haven't been seasoned in the game long enough, which I can understand. But what they're doing is they're looking at it going, well, everyone's been talking about positive cash flow for the last 2, 3, 4 years and that you've always been able to get it and blah, 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 which you haven't always been able to get it. You've only been able to get the last few years on standard deals because interest rates were so low. But that is what they've walked into with the psyche of thinking is 100% possible. And when you turn interest rates from 2.5 to 6.5, 7%, it's a very, very different equation, very, very different story. And that net cash flow at the end of every year is a very, very different number. And you know, I have had some people that come through going, I'm not going to buy anything unless it's at least $1 positive. And I'm like, well, that's just stupid. Because if something was $1,000 a year negative or $2,000 a year negative, but you're going to wait 4 months for that one deal that's $1 a week positive. It's actually an inferior property because it's in worse condition and you're scraping a higher yield because of that. And you just lost 4 months of the market because you were dicking around waiting for your something that was $1,000, you know, in front of the $1,000 a year negative. Or you could have got in quicker, better property, you know, in the market faster and all the rest of the sort of stuff as well. It's just an idiot decision, you know. And I've had people come through and say, and I'm the first one to say, man, I don't care. Go do something. If you want to go do something else, like if you're not going to listen to me on this thing, it's silly because you've just had your head in the sand and you haven't actually played the game over the last few years, you know, to be able to witness and see the difference in the way it works.
And that comes from education, right? And I mean, that makes a lot of sense for a lot of people. If you said to someone, give me $1,000 and I'll give you 50,000, people would say, okay, great.
No worries.
But when it comes to this scenario, because they're losing that $1,000 up front, every month they might be tipping in 500 and they can't see the growth. It's not until they refinance that deal and realize that they got 50 grand to put towards a deposit and they go, oh my God, this was a no-brainer.
Yeah. But also, man, all it takes is $20 a week. Like, look what we're talking about here of the amount of rental growth that's coming in at the moment as well. If a deal's like $1,000, $2,000 a year, even $3,000, $4,000, $5,000 a year negative at the moment. All it takes for, all right, I won't say all it takes, but for a $5,000 a year deficit, if everything remained the same, would be $100 a week increase in rent, which is a lot. But we're going through some massive bloody rental gains at the moment. But you think about five grand a week, you know, let's say in the next 12 months, interest rates just come back, even if they just started at the end of next year and they came back by 0.5%, and let's say that was 2 or 3 grand, and then your rents went up by $40 a week, there's a deficit plugged. That's literally it plugged in sub 12 months. And that's where I think the market's going and how it's going to happen. So like getting hung up on something being slightly negative in this environment and then foregoing doing deals or being too hung up on it from that front, people are missing the point. And like I've been through it before where I went through my period of not buying deals unless they were positive and I missed opportunities. And I've been burnt by that before of missing opportunities because of whatever reason with this sort of stuff. And it hurts. You know, it hurts when you look back, you know, 3, 5, some of these things now, I'm looking back 10 years ago going, holy shit, like could have done some of these deals at like 300, 400 grand and now they're worth 1.2, you know, million or more. Like, do you think I'm kicking myself over that loss? Like, you know, it's...
And I think it gets down to your priority, like understanding what your objective is. Yeah. So if your objective is growth, then why are you hell-bent on that yield and trying to make $1,000 a year if you're missing out on an extra 20, 30, 40, 60 grand of growth? So again, folks, just without laboring the point, understanding the reasons why you would be holding these kind of properties.
You've also got to play the hand you're dealt. So at the moment, everyone is dealing with this same scenario. You make the best of the scenario. This is a scenario we're in right now. Low interest rates are never going to last forever. High interest rates are never going to last forever. We aren't at long-term averages right now. And at some point, we're going to balance back out to that. But it was never going to stay at the golden times like it was there for years. That's why, remember you and I spoke multiple times because you were getting advice around just leveraging this portfolio to the eyeballs and running off 3% interest rates. And I said, mate, you need to build in debt reduction because at some point, interest rates are going to move again. And that cash flow you think you've got, you're not going to have. And so we changed your strategy and built your strategy a little bit differently because of that as well. And man, I think like that's... People just need to look at this from a high level picture of it is just a blip. You know, it's a small window in the long-term game. Yeah. That's a quote from the famous Lukey Chusen himself.
Is it?
Small window. Yeah, he said that to me. Small window or small picture or I don't know, some fucking thing. Small window in the long-term game of what we're trying to do here. And if you can pick up another 2 deals, and each of those deals, you make 20 grand on the way in and they grow by 30 grand or they grow by 40 grand a year in the first 12 months. You got those 2 deals. Let's just round that to $100,000 that you make in that time frame. 20 on the way in, 30, 40 weather growth, whatever, average it 100,000. If they've cost you $5,000 a year each, you're up 90,000. And you're pulling that out, you're buying another one just before the market bloody starts its proper run.
So people think by doing nothing, they're not losing out. But the cost of doing nothing, you really need to pinpoint that and understand that by not taking action, you're actually losing a significant amount of money. And because you're not feeling it, you don't think it's happening.
Yeah.
But you are.
Yeah. Yeah, 100%. And we're not talking about going out and buying something, blue chip that maybe millionaires or billionaires would maybe buy, and losing $50,000 a year. We're not talking about being an absolute idiot and doing that.
Anyone in particular you're talking about?
Potentially, but we're talking about buying something that's affordable to hold. We're in the long-term high averages. When that comes back down a bit, we'll be back into a neutral to positive position. And the average everyday person is able to afford that thing and actually accumulate and build a portfolio like that, because that is how you do become a millionaire. Maybe not a billionaire, but who needs to be a billionaire?
No one does.
So
it's taking that macro view.
Yes.
Take yourself out of the blinkers of that really narrow focus of that $500 a month or whatever it's going to cost you, and take the bigger picture of what you're trying to create, and that's your wealth. And your wealth is only going to come by building and compounding your money and leveraging out to create a portfolio. And you can't create a portfolio if you're not buying anything.
100%.
So I think that's
moral of the story, guys. We've almost kept to time here, but I don't know if you've got much more to run through here. But moral of the story for me is it does not matter where interest rates are. It does not matter, because you need to continually accumulate if you're wanting to build this journey.
Yeah.
If you are struggling, if you literally can't afford it, it's a different story. And you've just got to take that into the equation, all the rest of the sort of stuff. But 95% of people that are listening to this would be able to make a purchase and carry it through for the next period of time. You've got depreciation. You can write things off. You can do all the good stuff to write everything off, to get it to a small little, nil balance, as close to nil balance as possible to hold this thing for a year. But the aim of the game is continual accumulation. That is what makes you wealthy, and is really what would build wealth in that longer term picture as well. She's going to make sure you're focusing on that. You're doing all the right things going to move you towards a game. The continual accumulation is what's going to make you wealthy, guys. You hammer home, you keep moving forward with that, and that is what's going to make you wealthy. If I give you one final example, Jimmy, before we wrap. During COVID, most people in the first year of COVID were getting their interest rates in the 2s, sub 3%. I went out there and bought aggressively, bought over 10 properties, majority of which in Southeast Queensland, because I could see the value that was there and the deals that were on offer at the time as well. I was paying in the 5s and in the 6s when everyone else was paying in the 2s on low doc lending to get those deals, doing everything I could. It was shark money. Bull shark money. Great white shark money.
Because you wanted to get the deal,
shark money,
right?
Because I wanted to get the deal. All of those deals doubled in a sub 24 month window. Imagine, and I'm not saying obviously that's exactly going to happen in this scenario, but I'm painting the picture of, let's say you're $5,000 a year out of pocket on one of these deals, but you're making $50,000 in the first 12 months on it. That's a great scenario. All right. Yes, it's not as ludicrous as what mine was, but I did go for a ludicrous scenario in terms of what I was doing, but I saw the opportunity. I went hard in it, and I wouldn't be sitting in the position I'm sitting in right now if I hadn't done it. And as opportunity cost of not doing it, and yeah, man, like the proof is in the pudding when you put it to work.
So I think we've laid this to bed. The fact that if you should be investing in a high interest rate environment, if you're not investing thinking either A, prices are going to reduce, or B, prices will be cheaper down the track, I think we've dispelled that myth. But the one thing I want to ask you, if you're listening to this, you're realizing this is a no-brainer. You don't need much more convincing to understand the metrics of why prices will increase and why it's a great time to invest. But tell me, when you're looking at the media and blocking that out, because I think that's a big thing. The people listening to, can you just I know we've mentioned it because, builders are going bust, house prices are falling in certain markets, media, your family, your dad saying, nah, son, don't do it. What do you think?
Block it out. Don't even listen to it. Do not listen to anyone that hasn't done what you want to do. I guarantee you most media outlets haven't done jack shit. Like they haven't done anything. Yeah. The dudes sitting behind the panel haven't done anything. Yep. So I would be blocking their any of that sort of stuff out, any of that sort of news stories. I wouldn't even listen to the news. Yeah. Put it that way. Any of your friends, family, anyone in your circle, if they haven't done what you want to do, send them this podcast. Leave it at that.
Last thing for you.
Yep.
with higher interest rates,
Yep.
you generally can't borrow as much.
Yep.
So you might be buying a property for less value than
Yep.
what you think. People think that's not a great investment. If they can't buy it for 500, but you can buy it for 350, don't let that stop you from doing that. Just to labor that point to the people.
Yeah.
Why should you be continuing? Whatever your price point you can buy.
Well, one of the funny things is like the lower entry price that you buy at, more than likely the better yield you're actually going to get off the property. So it might actually be easier to hold that asset. I bought plenty of properties and like that was COVID was what 3-4 years ago, 2019 or 2020. No, it was 2020. I was buying aggressively during that window. Literally less than 3 years ago, I bought most of those properties. Had a ridiculous result, and they were pretty much all sub 350,000, between 250 and 350,000. Pretty much all of them went pretty close or doubled in that time frame. And yes, that market is now gone. That market now you cannot buy for that same money, and you wouldn't get the same results in that market. But there are other markets. That's the whole point of engaging people, understand how to source that, how to pick the right locations that are going to produce those results. That's why I went super bullish at that time as well. I could see the writing on the wall. I saw what was going to happen. Then we pulled the money out of that market and went to others and have done the same thing. And have been on ridiculous runs in those as well. And we're in that same period now where we're pulling money out of that and putting it into other markets that are showing exactly the same signs, the same writings on the wall, the same market pressures they're building. They're going to produce the same results in the next 2 to 3 to 5 years. So there is always ability to buy. There is always ability to make significant money regardless of the purchase price and the entry point and anything to do with the market. It's market pressures that drive a market, not price point.
So if people are getting their interest rates at the moment and they're trying to get a refinance, what price point can people expect that they can still get into buying a really good quality property?
Like what's the bottom end?
Yeah, bottom end. Like, because I'm thinking people thinking, I can't get 500, but I can only get 320 or 350. They're thinking in their own brain, I don't want to do it. No, it's not.
We're still buying bangers of that money. You think about the simple equation. It's easier for a property worth 300 to get to 6 than it is for a 6 to get to 1.2. You're talking $600,000 worth of growth compared to $300,000 worth of growth. Now, if you bought a $300,000 property in a market where there's also $600,000 properties, so we're talking the same market, and there's plenty of other locations out. I'll give you a simple example. A market like Ipswich or Logan in Brisbane in COVID pretty much did pretty close. If you bought at the right money, you pretty well did 100% growth in sub 24 months. Brisbane did really, really well. Most of the city did about 50 to 60%. But the lower areas where you could buy it, 250, 300, 350K, most of those deals pretty well doubled. It's a lot easier for a 250, 300 to jump to 500, 550, 600 than it is for that 600K property to jump to 1.2 million. It's not saying that there aren't great properties to be bought in those sorts of areas and in different markets. I actually really like the $500,000 to $600,000 bracket because the way I look at it in those markets is the 5 to 600K properties in those markets actually have a better or an easier
$350. I'm like, dude, of course you
still
can.
buy. Yeah.
Of course you can.
Yeah. We would do like a decent number of deals every month that are still under 350K. Yeah, the markets are like, there's not as many markets in the country anymore.
Yeah.
I think in the next couple of years, I think it's actually going to be extremely hard to buy anything in Australia sub 500K in the next few years that isn't a piece of shit. Like I honestly think most capital cities, it's going to be near impossible to buy under 4, but I think 5, under 4 I think is going to become non-existent in the next year or two. And I think it almost is already actually. So probably the next 12 months it'll be non-existent. But even Australia-wide, I think And when you really look at it, it comes down to building costs. And when building costs of a new home are getting near like 400 grand for your standard 4x2, 4-bedroom, 2-bar, 2-garage home, your standard 200 square meter home, and they're starting to turn into 350, 400K, when people are building those in these sorts of areas, even just that, naturally, that minimal as an absolute last resort alone will push the market.
Yeah,
but all your cheaper properties in that area, they're not going to stay at 300 if there's newly built properties at 5 to 6, they lift with it. So I think it's honestly, I was talking with this about this with Lukey like a week or two ago as well. I just can't see it staying at that sort of price point for long. So yeah, it really doesn't matter, and it really depends on the city you're in as to what's like a good affordable price point as well. But yeah, there's definitely still plenty of locations. Sub 3's drying up, but there's still plenty sub 3, sub 350, 400, and obviously that $400,000 to $600,000 bracket. There's some really juicy locations and deals that we can do in that sort of money as well. So there's plenty of opportunities out there for sure.
Well, hopefully, folks, you've got taken a lot of confidence out of this. And Sammy, very eloquently put, you brought your A game today. I'm glad you did.
Thank you, mate. You brought your red hat, and that's about it. But your red hat
glad
and
I could be here.
That white stained shirt again. I don't know what your obsession is.
I've got about 5 of them. So
it's very questionable.
No.
Very
Get onto YouTube, folks. Get onto YouTube and let us know what you think about the T-shirt.
Jimmy, mate, thank you once again for jumping on, bringing your red hat. No other game. Listen. Out there that would take great value out of this episode or has been talking about this episode and you think could shed a bit more light, please send it on. I think personally that was a pretty good app. There's definitely some gold in there that a lot of people could take some value out of. So if you're trying to put a nice, good, positive spin, if you're trying to be that high level in the circle of influence, I'll be shooting this out to a couple of people and get them thinking on that positive train instead of being negative about the high interest rate environment at the moment.
I was just going to add something. If you're listening to these podcasts, and I often do this, I don't know about you, but sometimes when you listen to it the second time, and I've listened to a couple of episodes quite a few times, you pick up something different that might inspire you to take action. So don't ever think that you just listen to it once and it just comes in and might just pick up that little point, and that one decision, Sammy, might make the difference in the spark of your portfolio to get you to that next
100%.
level. So not only just sending it to a first-time listener, but for yourself out there, folks, listen to them over and over again until it gets to that point where it is a no-brainer for you to take action.
I don't know how many people you would call, because I know you obviously speak to a lot of people at the front end. The amount of people that Lukey and I speak to at the back end and like our client success team that are obviously trying to help, keep people on the journey on the right path and everything as well as we go through. But the amount of people that come back through to us and go, I listened to the potty and like I was inspired, but I don't know if I fully believed it.
Oh yeah.
And then we did a deal, and then we did the bank val, and then we pulled the equity, and then we bought again, and then I was like, holy fuck. This thing actually works.
I often get it's too good to be true. It sounds too good to be true.
Yeah, we get that all the time. Look at the reviews. You go on, buddy, the Trustpilot, and you go have a look at the reviews. Yeah. The amount of people that go, I thought this was too good to be true. I'm going to repeat the 4 things I just said just then, and it blew me away. And it was exactly like they kind of said it was going to be. And that's the thing. We're super committed to that. And man, yeah, this is why I love it. And being able to deliver on that, and exactly like you say, people think it's too good to be true. And you follow through and they have a great result. They get the bank val, pull the equity, go again. And then when that sparks and when that happens, and people always talk about getting bitten by the bug, of the property bug. And that's when you win. So you go buy some overpriced piece of shit, blue chip property that costs you 50 grand a year. You're not going to get bitten by anything except for a mistake, right? But you go buy something that produces money for you, you pull capital out of it, it pretty well takes care of itself. Maybe you need to chip in a little bit for the first couple of years, but then it starts to snowball and take off. You're going to get bitten by the bug, and you're going to understand what it is that's out there that people froth on so much when it comes to property. Crazy. I had no right as a boy from the bush making bloody not that much money to build what I did, because I got bitten by this thing. It snowballed into a beast, and the rest is history. And honestly, anyone can do it. These days,
you're right.
These days, you probably need a bit more of a team than maybe you needed to 10, 15 years ago when I started. Maybe it was a bit easier back then. Maybe you need a bit more of a team now to guide you along there properly from a structuring, from a financing, from a buying perspective as well. But yeah, you get started on this thing and you do it properly and you focus on that continual accumulation.
Yeah.
Guarantee you almost anyone can retire on what they're chasing in a sub 10-year window if they focus on that continual accumulation. They buy in the right markets. They don't listen to the wrong people. They follow the right mentor. I guarantee you almost anyone can get to that, get to their goal in a 10-year window.
And success leaves clues. I mean, we talk about this a lot. If I always say to people when I look at your portfolio, the strategy that Sam has done, whether you're buying 40 properties or 4 properties, is exactly the same. So you're not doing something. You're not reinventing the wheel here. We are doing something and following a tried and proven strategy that works because of the results, not 100%. A theory. So if you get that in your mind and you go, okay, well, I'm just copying someone, that's the first tick. And then you ask yourself, if I don't take action, if I don't do this, and I've said this plenty of times to myself, what is the result? Like ask yourself that question. If you do not take this action and make the decision, in 10 years or 15 years or 20 years, where are you going to end up?
Yeah, 100%.
And if you just ask you that one question, you're not going to get where you want to get to. So do you want to have a crack and give it a shot? Or do you just want to think, oh, nah, I didn't because I wasn't sure? Because I've done it. Yeah. It's the regret weighs tons.
Yeah. Man, I'm with you 100%.
So 100%. Hopefully this has inspired people to take one step in that direction. Whether it's having a conversation with your broker, booking in a discovery call, starting the momentum, move towards your goal. Who said this? I don't know if it's Anthony Robbins or your mate Tony. He says that when you want to create momentum
who's Anthony Robbins?
In anything, you need to take one step, Sammy. One little point. If that's booking in a call. Calling the accountant.
100%.
So, folks, if you take something out of this, it's all good and well listening and absorbing it and driving to work and getting inspired and all that.
Or maybe you're making excuses, and maybe this is the reason why you're sitting at 40 grand and you need 50 to 60 to get started. But this is your excuse to, I'm gonna party it up for the next 12 months, and I'll park it, and the excess cash I'll go and have a good time for the next 12 months, and when interest rates come back, I'll start again now. I guarantee you, I promise you're gonna kick yourself, because if you've done the right things and bought the right property, you would be pulling out. You may be up to property 2, property 3 by the time they start coming back, and then it starts to run, and then you're going to become wealthy.
So, all right, well, I think we nailed it.
I already said about sending it on for a bloody for us to share it around. But listen, I hope you enjoyed it. If you did, we went for an extra 10 minutes beyond that.
It was a bit of gold that was good. Last 10 minutes.
That was good. But if you enjoyed the last 10 minutes.
It's because of the hat.
Terrible hat. Terrible
red time. I was in the red zone.
You're in the red zone, mate. You're in the blue zone, the Centurions. Have you seen that show on Netflix, The Blue Zone? Everyone over 100?
Yes.
So have they interviewed you?
I will live to over 100. You won't.
What do you mean? Bro, you're already 3,000 years old, you old bastard. Fucking walking stick came in with a Wizards cap and a bloody... He changed that thing off. Go pull the Wizards hat out, mate.
I'm going to bring one. I'm going to bring a Wizards hat.
Back in the day, I was going to do the Wise Wednesdays. I was going to get a big beard and get a hat, a magic hat. I was like, ooh.
That would suit you.
That would have been good.
All right. Let's wrap it up. Come on, we're going to go.
Shut up, mate. Thank you guys listening once again. It's my third sign off. I hope you enjoyed it. If you did, send it around. Give us a 5-star review. And until next week, guys, we bloody love ya. Signing off till next week, Scouting Australia podcast.